ever heard of factor-based investing? You've probably heard of stock picking. You've probably heard of indexing. Today, we're going to be speaking with the portfolio manager who is a world leader with regard to factor-based investing to help you to understand how this way of looking at things is taking the world by storm, gathering assets, and helping investors get both better performance, but also to make better wealth decisions.
This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John DeGuy, the portfolio manager with Design Securities in Toronto.
This week, we're speaking with Daniel Ong. Daniel is a portfolio manager with Avantis Investors, and he has been there for a little while. And for 15 years prior to that, he was a portfolio manager with Dimensional Fund Advisors. He's one of the founders of Avantis who came over from Dimensional. So it's great to speak with you today. Daniel, how are you?
Thanks, John. Thanks for having me. I'm doing great. Looking forward to this conversation.
Perfect. So I wanted to begin by introducing Avantis to my listeners. A lot of people don't know who Avantis is. You've come into Canada fairly recently in a partnership with CIBC. You've been gathering assets like mad in the US for a number of years. I wonder if you could maybe A, begin by telling me about Avantis, and then B, telling me a little bit more about maybe yourself, but also why the value proposition is different. But let's just start with the company. Tell me about Avantis.
Yeah, so Avantis is a brand within American Century, very much like iShares is a brand within BlackRock. The reason why we wanted to have a separate brand is because we manage money differently. American Century is traditional stock picking, active, valuations based. We're also active, we're also valuations based, but we do it in a systematic manner. So because we do it in a systematic manner, we're able to apply the analysis across more names than a traditional active manager and a lot more cost efficiently. So when you look at our portfolios, they will be more broadly diversified, low fee, but unlike an index, you don't have to give up the ability to outperform. So that's been very attractive for clients. And that's part of the reason why the assets under management has grown from zero to $162 billion as of last week.
In the US. And it's growing pretty quickly in Canada. You've only been in Canada for a few months. Can I maybe ask you, Daniel, to take a moment to maybe offer a little more perspective and color on what you just explained? Because I'm familiar with the value proposition of your product and others like it and have been for some time. But most people listening today would not be familiar with what might otherwise be called factor investing. So just for the people listening at home, this is not like indexing where you try to replicate a benchmark and you're just buying all the names in the benchmark. This is not like traditional portfolio management where you're doing fundamental and technical analysis and ultimately stock picking. This is something that is a bit of a hybrid of both, but nonetheless altogether different. But I will leave it for you to maybe explain the variations, the nuances, the wrinkles, the things that make it, in your opinion, better.
Yeah. So what we're doing is buying companies or targeting companies that have high profits, good income statements, good balance sheets. But despite the fact that they have these positive characteristics, they have low prices. This is not a new concept. I think traditional active managers are after the same thing. They want companies with high profits and low prices, but they go about it in a different way. They're highest conviction, best 50 stocks. And if you get them right, you're a hero. If you get them wrong, you're a zero. Now, what we're able to do is able to apply our analysis or targeting companies with high profits, low prices via ratios that can be applied across many names. A lot more names than a traditional active manager. So for example, thousands of companies in a core type of portfolio instead of hundreds it's a way for us to, in a way, systematize active management. We're after the same things, but because we're applying it kind of via these ratios, companies with high profits for the equity you get, companies with high book value for the equity. That's what we're targeting here. But in a very basic terms, we're buying companies with high profits and low prices at the same time.
And I think that's the sort of thing that if I were to offer my thoughts, is that instead of having analysts and hotshot portfolio managers and red spenders doing their work in a corner office, you're basically sorting with spreadsheets and looking at ratios that are applicable. And basically any company that passes the screen can be purchased to a greater or lesser extent and be part of that opportunity set. And so that instead of having 50 names, you could have 1,050 names in a portfolio. And obviously that offers more diversification. Let's talk a little bit about diversification, but also risk-adjusted returns. So compare and contrast your methodology to maybe each of the other two methodologies, the traditional indexing and the traditional stock picking, to offer your thoughts as to what it means for risk, what it means for return, what it means for turnover, and what would the investor experience be like if you were to use an Avantis product as opposed to one of the other more well-known approaches?
Yeah. So imagine if you were to just buy companies based on cheap, book to market, companies with high book value for the price you pay. Well, you're buying companies for cheap, but some of these companies are cheap for a reason. They're not making money. So great, very high book value for the price you pay. You can get a company like Rivian, the car company. They just had a capital raising, lots of equity, and you're paying a low price for the equity. If you're focusing just on book to price, you would target a company like Rivian. Now, you haven't looked at the income statement yet. If you looked at the income statement, you would know that Rivian is burning through a lot of cash. It's not making money. And so the situation you have there is you paid a low price for a reason. It's not making money. That's not necessarily high expected return. On the flip side of that, what if you buy companies with very high profits? That sounds great. Very high profits, great income statement. What if you're paying a high price for the equity? If you never looked at the balance sheet, you wouldn't know that you may be paying a high price for those high profits. And again, if you have that situation, that's not necessarily high expected returns. So what we're after instead are companies that have high profits, but despite the fact that they have high profits, the market is assigning a lower price. Why would the market do that? Because it's assigning a higher discount rate or a higher expected return for this company. And so by targeting companies with a high combination of the two, we're able to more efficiently target companies that actually have higher expected returns, not ones that have high profits with high prices or low prices with low profits.
Would it be fair to say, and I don't want to put words in your mouth, but my impression listening to you speak is that your methodology might be what some would call a third way. So the two traditional ways is you buy the benchmark or you engage in stock picking. And yours is sort of kind of somewhere in between, but nonetheless different as well. Down the road, how do you see the industry evolving in, say, 10 or 20 years' time? Will there be roughly 1/3 in each of the three different methodologies, or will one come to dominate, and why or why not?
Yeah. So folks have asked, why are you growing so fast, Avantis? And it's because investors are looking for lower fees. And as they go from traditional active towards, let's say, index investing, we fall somewhere along the path. Because what we're offering are broadly diversified portfolios like an index, transparency, low fee, but you don't have to give up the ability to outperform. And so that's been attractive to clients. And it's part of the reason for the growth in the assets under management. We do think that trend will continue. Investors will continue to look for lower fees, but they still want that ability to outperform the market. You can easily buy the index. The give up is, you're getting market returns. And these days, with the drawbacks of indexing being, look, the price of a company increases, the market cap increases, and the weight in the index will increase. These are creating concentration issues. So it can continue regardless of valuations. Investors have been more open to valuations, a valuations-based approach. But you can do it in a way that's not just traditional stock picking best 50 stocks. You can do it via the broadly diversified portfolio and pay a low fee on top of that.
We've been dancing around this, and I've mentioned the word wasn't twice in passing, but risk. What does that mean for the variability of a person who's using your approach in terms of what they should expect for a standard deviation as compared to another approach?
Imagine a portfolio that buys the market and tilts towards the companies that have high profits and low prices, and away from the companies that have low profits and high prices. Well, the companies with high profits and low prices, they do have higher standard deviation, but so do the companies that have low profits and high prices. So if you're tilting away from the companies that have low profits and high prices towards the ones that have high profits and low prices, you're actually getting very similar market-like standard deviation, but with higher expected returns. And that's attractive to clients. Higher expected returns with similar standard deviation.
It's interesting because that then turns into a question about, say, asset allocation, where you might have had, say, a 50-50 portfolio, or let's say a 60-40 portfolio, 6% stocks and 40% bonds. But because of your approach, you could hopefully expect to get, no one knows for sure, but hopefully expect to get a higher return on your equity allocation. And then you could therefore move your asset allocation from 60-40, because you're getting hopefully a risk premium with regard to your equities. You could maybe dial it down to 55-45 or 50-50 and still have a similar risk return experience with a lower equity allocation as part of the strategic allocation going in.
That's exactly right. So if you are taking on tracking error, you better hope that tracking error is efficient tracking error. In other words, you're being compensated for it via higher expected returns. If you're only moving away from that market portfolio towards the companies that have higher expected returns, that's a very efficient way of doing it. A lot more efficient than just buying cheap or just buying the companies with high profits. So you're right. You don't need as much. Now, the percentage that you need is, we can debate that, but yes, you don't need as much.
So I will talk to you about one specific product, and I'm really going off I'm going off script here because I don't normally do this with anyone to talk about a product, but because this product of yours, it goes by the ticker symbol CAGE, CAGE. The GE stands for global equity. So it's a global equity ETF. It's been, I think it's safe to say, the eye candy in the window of all your product offerings here in Canada, and it's certainly gathered the most assets. Help me to understand, why that product in particular has done well, and what it is that people find attractive about it, and maybe offer a value proposition of why people should hold it. Because of all your products, it has gathered, I think, by far the most in terms of AUM here in Canada in 2026.
Yeah. So I know for compliance reasons, I'm not allowed to talk about particular products, but let me just talk.
That's why I usually don't ask about it. So let's keep high level. I want to get to specific.
So at a high level, we can create a strategy that is an all-country strategy, all cap, all style, just the entire market, but tilted towards companies that are attractive, the companies with higher profits and lower prices, and away from the ones that have lower profits and higher prices. So it's a portfolio that you can either buy all the individual companies, or you can combine it via the ETF components. You can buy a lot of the different ETF components and put it into one portfolio to give you that global all-country portfolio. And that is a very efficient way to give you all-country exposure, because you can rebalance just by rebalancing the ETFs instead of rebalancing each individual security. So it's very efficient from an implementation standpoint, and it would also be very cost efficient, which would translate into low expense ratios. So from an end client perspective, you could now get a portfolio potentially that has all country, all cap, all style, tilted towards with a valuations-based approach, but with a very low fee. So I've tried to keep that as high level as possible.
And that's perfect. No, that's exactly how I wanted, Daniel. So thank you. Yeah. So I think it was interesting having this conversation with you, because sometimes we'll talk about strategies for tax reduction, and sometimes we'll talk about estate planning and other things. But the podcast is called Make Better Wealth Decisions. So ultimately, anything with regard to decision making. I've been focusing increasingly on retirees and maybe a more pension style approach. But when I realized that I hadn't spoken with you or anyone else from Avantis previously, I realized, okay, I need to get Daniel on the podcast because this is a subject matter that I hadn't explored previously. And the point that I think you are making, without using the word decision, is you're helping people make better wealth decisions by using products that are mathematically robust, proven, empirical, and nonetheless deliver results in a cost-effective manner. So with that in mind, I want to end with the question that I always end with. The podcast is called Make Better Wealth Decisions. If it was up to you, Daniel, what advice would you give to my listeners to help them make better wealth decisions?
Make decisions not based on headlines. Investors have never been rewarded for making portfolio changes just based on headlines. We know that there's negative headlines and positive headlines out there, but the investors that have been rewarded are those that have remained disciplined and have a longer term view when making their investment decisions. Now, your risk profile may change, and of course, you should change your decisions as a result. But history has shown that investors have not been rewarded for making changes just based on headlines.
Thank you so much for your time today. It's been a real pleasure, and I hope to speak to you again soon.
Yeah, likewise, John. Appreciate your time, and thank you everybody for letting me into your household.
If you're worried about the current investment climate and your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.